the U.S. economy and here in the state of California. What is going on out there? It's funny. We have continued at some level to continue to live under the shadow of the Great Recession, what happened back there in 2008 and 2009. Now, if you're looking around the roads and you're seeing how packed they are, and you're looking at the financial markets, and you're looking at how asset prices are bouncing up, and suddenly people are out there spending more, and all sorts of good things are happening, the question on everybody's mind is, wow, things seem okay, it seems pretty good. That means it must be coming to a crashing halt any minute now. In fact, this idea that somehow or other where we are is we're at the sort of at the edge of some sort of precarious drop-off seemed to be reflected to me recently in this Bloomberg report, coming in 2018, the U.S. recession. I love this. This is a Bloomberg survey, and they asked a bunch of economists when the next recession was going to be, and they came up with apparently 2018, although bimodal, there was a bunch of votes for 2020, as the case may be. This is, without a doubt, one of the silliest things I've ever seen in my entire life, because it's completely the wrong question. When will be the next recession is not what you should be asking. Look, is there going to be another recession? Of course there is. There's always another recession. Will we know when it's coming? No. Why? Because you have to ask the right question, which is what is going to cause the next recession? Not when is it going to be, because they don't just happen. They happen for a reason. Every recession in the U.S. economy has had some sort of underlying driver, something that pushed us into that particular situation. The drivers of what happened in 2008 and 2009 were very much in evidence in 2005, 6, and 7, if you're willing to open your eyes and look at them. Today, back then I was called Dr. Doom. Today I seem to be the optimist, because I'm not talking about recessions. And yeah, sure, I know, 20% or 15% drop in the market over a couple days, and everybody's a jitter over what's happening in Asia, and oil prices are way down, and wow, it must be a scary time out there. But forget that. That's just noise. Forget the markets, as the case may be. And for anybody over the age of 40, you probably recognize my little reference up there. And if you're under the age of 40, you probably have no idea who the Sex Pistols even are. But for the rest of us, we probably know who those guys are. Here's the real economy. Because for me, this is where it lies. What is actually happening in the U.S.? We're not slowing down. There's no sign of any kind of edge, if you will, of the abyss that we're coming up to. Quite the opposite. The U.S. economy seems to be slowly but steadily picking up steam. We had a slow start to the year again, but it's already gone, 3.9% in the second quarter. Labor markets have clearly turned the corner over the last couple of years, and the labor situation is looking much better. There is not an asset bubble right now, not even close to it, and I know people are talking about that again, but we're not even close to it. Housing market is due for yet another bounce, and that seems to be moving forward. Credit is expanding on many levels. And while a lot of folks out there are worried about, for example, these low oil prices, we should be thrilled. Cheap commodity prices are a net boost to the U.S. economy, not a drag on our economy, and that's going to be pushing things forward as well. And last but not least, our fair state, the state of California, a state that was more or less written off in 2010 and 2011 by those folks out there who said we're just too highly taxed and too regulated to actually grow. Well, we've been proving them wrong over the last 3 years, because this state is in the lead rather than the lag of overall the U.S. economy. Now, it isn't to say there aren't headwinds out there. There are always headwinds. There's really challenges. What would they be? Well, state and local budgets are still clearly stressed, and we have those pension issues we're dealing with. The global economy, not Europe this time, it's really an Asian situation, something you got to keep an eye on. Bad financial regulations, which are distorting the housing market. Frothy markets. I said we're not in a bubble yet. That's the big key here, right? I mean, today's hot markets can turn into tomorrow's bubble markets, but we haven't gotten there at this particular point in time. Obviously, long-term issues of growing inequality and political gridlock cannot be ignored. Those issues, particularly in D.C., are problematic. And of course, here in California, we're seeing a rapid erosion of housing affordability. All issues we need to pay attention to, all issues we need to work on figuring out solutions to. But on the other side of it, not one of these things suggests to me that the current expansion we're in the midst of right now is going to come to an end anytime in the near future. And that's good news, because what it means is we ought to be focusing more on these midterm challenges. Those midterm challenges are exactly what, if you will, are going to be what we have the time to focus on right now. So let's stop panicking about the short term and really start, if you will, considering the midterm situation. So let's get into the numbers and talk about where my optimism is coming from. Again, slow start to the year, 0.6% growth in the first quarter, but second quarter came in at a very solid 3.9%. The really weak part of the first quarter was consumer spending and the opening of the trade deficit. Consumer spending was down mainly because last Christmas was hot. This has been an ongoing, shall we say, development or pattern in the U.S. economy. Christmases are getting bigger and bigger, and therefore the post-Christmas hangover is getting worse and worse, as the case may be. But by the second quarter, consumers bounced back and added almost 2.4% to growth in the second quarter. Investment's been ticking along at a good pace, a little bit of a slowdown in structures. That has to do with the decline in oil investments. But beyond that, other parts of the structure market is fine. Residential's bouncing back nicely. We did see the big widening of the trade deficit last year and the beginning part of this year, but that even stabilized in the second quarter. So we're looking for the trade situation to become basically net neutral for the rest of the year. And last but not least, government, while stressed, seems to be bouncing back. There are signs that local government is starting to put money back into the economy, primarily in education at this point in time, but that's a good starting point. I don't have any problem with that. So it does seem like things are turning around a little bit on that particular front. The consumer, of course, 70% of the U.S. economy, a primary driver of things, something you should always keep an eye on. Consumer spending has been doing great. You know, for a number of years, it was running in the 1 to 1.5% range. People were constrained by a lack of credit, by a very weak labor market, by a lack of confidence, if you will, in what was going on in the U.S. economy. Over the last year and a half, that has changed. You're starting to see consumer spending start to pick up quite a bit. And right now, yet again, growing at about a 3.5% annualized pace. Very solid numbers there. And of course, it's not being based, shall we say, on people being over-optimistic or picking up too much credit. The savings rate is staying in a nice, steady 5% range. So people are basically spending more because they have the ability to spend more. They're earning more money. Relatively good news there. People are starting to borrow a little bit more. Consumer credit expansion has been running in the $23 billion range on a month-to-month basis. That's a very solid number. We like that number. Some folks say, well, wait a minute. Should households be leveraging up again? Is this something we should be afraid of? Well, you know, if you go back to 2007 and 2008 and 2009, and you remember the big meltdown in the lending markets, particularly for houses and credit cards and auto loans, it was never about the quantity of debt that was in the U.S. system. It was always about the quality of debt. You know, on the right-hand side, I have something called the U.S. financial obligations ratio. It's an estimate of the percent of household income being used to service current financial obligations. Back in 2007, that was about, 18% or so. That's higher, but not super high from a long-term perspective. The reason it wasn't so high is, while it is true that Americans were picking up lots and lots of debt, as the case may be, interest rates were also going down at the same time. And on balance, it was more or less neutral. And look where we are now, with a lot of the purging of the bad debt that was in the system. Financial obligations ratio is at a record low level right now. People can afford to borrow, and the fact that they are borrowing is a good sign of the ongoing growing health of the U.S. economy. As for delinquency rates in various sorts of debt, they continue to fall. The one place that isn't true is student loan debt. And boy, have we heard all sorts of information about the student loan crisis over the course of the last year or so. Student loan crisis. This makes me a little crazy, to be perfectly honest with you. First of all, we don't have a crisis. It is true delinquency rates up. They're running about 12 or 13%. A decade ago, they were running about 9%, so a little higher than they were before. But take a step back and ask yourself, is this a crisis at this particular point in time? Well, your average student that graduates from college today is graduating with about $25,000 worth of debt. And you might say, wait a minute, I thought it was $31,000 worth of debt. That number comes only if you exclude all the people who graduated without any debt at all. Overall, you could cross every student graduating from college today, they have about $25,000 worth of debt. What is that? That's about a mid-range Kia, as the case may be. That's not a crisis. And by the way, it's also very interesting because you always hear the stories of people coming out of college with $100,000 or $250,000 worth of student loan debt. By the way, those are not the people who are defaulting on their debt. Because for the most part, if you racked up $100,000 to $150,000 worth of student loan debt, you're probably a doctor or a lawyer. And oh, by the way, you'll probably be able to pay that off if you choose to within 2 or 3 years of graduating, because the kind of money that even a beginning doctor is making in our economy today. It's really not that sort of crisis. What is going on out there? Two things. First of all, I want to point out that even though education costs have gone up, It is also the case, and by the way, all my high school students are back. You can be listening to this. If you hear nothing else today, this is what you want to listen to, okay? At the same time college costs are going up, guess what? So are the returns to a college education. Going from a high school degree to a bachelor degree today is as big of a jump in your lifetime earnings as has ever been. And indeed, if you look at the number for the net present value of a bachelor's degree, this is 1970 to 2013, and this includes the cost of education, the increased taxes you pay. You look at everything, go right through the numbers. The value of an education today, net present value form, is still running about $300,000. That's still a heck of an investment no matter how you look at it. And by the way, that's a heck of an investment even though some bad things are happening in our space. Where are the biggest problems right now? They're coming from two different places. The first place, of course, is we know about the fly-by-night for-profit educational institutions that were kind of taking advantage of some of these student loan programs that were expanded in 2009 and 2010. Don't need to name names. Some of them are being closed down and other ones are in trouble and so on and so forth. That's not a student loan crisis. That's just flat-out fraud, and those students ought to be relieved of that debt, and we should move on and not do that sort of thing again. I recognize the inherent problems there. But here's the second part of it. You know, we say that the average student increases their lifetime earnings by about $300,000 from getting a college degree. But that actually varies widely on a person-to-person basis. If you take a step back, and on the bottom here, we have some of the most amazing, some of the most fun data I've seen in a very long time coming out of the American Community Survey. We're actually able to pull out what people are doing and what kind of money they're earning. So we grabbed a whole bunch of 21 to 27-year-olds and we said, well, what kind of degree they get and what kind of degree and what kind of money are they earning? Well, as it turns out, guess what? People between 21 and 27 who have a bachelor degree, the top earnings are going to people who have an engineering degree, a computer engineering degree, chemical engineering degree, computer science, aerospace engineering, industrial organization engineering. You're starting to see what I'm talking about here. You've seen a trend, right? In fact, we don't get out of the engineering field until we get down there to the finance. But no matter how you look at it, here's the key. Basically, the degrees that make the most money when you get out of school tend to be the degrees that don't allow you to party on Thursday, Wednesday, and Tuesday night, okay? Turns out that getting a degree and what you put into it at some level is also a function of what you get out of it. Now, on the right-hand side, this is actually degrees awarded over the last 5 years for the same group of people, 21 to 27. And I want you to count how many of those, shall we say, degrees on the right-hand side are in the list on the left-hand side. And the answer is 1. And that would be, of course, finance. The number one degree awarded over the last 5 years or so is actually psychology, with almost 300,000 new psychology degrees being awarded in the U.S. economy. Now, mind you, psychology is important, and, you know, we all need a little help now and then, but I'm not sure we needed 300,000 degrees worth of help, okay, as the case may be. And needless to say, the average income of a psychology major is not up to snuff relative to many of these other occupations. We have business management, biology, general business, nursing, communications, marketing, so on and so forth. So the key here is this. We have to understand, you know, back when I went to college and I was getting a degree, you know, my parents said to me, my parents never had the opportunity to go to college. And when I was raised, we were raised in the atmosphere that you're going to college no matter what, because we didn't have the chance and you are going to have this opportunity no matter what. But I got to college and I said, what, now what? And they go, well, just whatever, go study something. Because back then, it was okay just to get a college degree. Back then, that was sufficient. But today, it's more difficult than that. It's more complicated than that. Today, it's about what you study and how you study and where you study. It's an investment. And like any investment, whether you're investing in a college degree, whether you're investing in a building, whether you're investing in a new company, you always have to sit down and ask, what's your business plan? What am I going here? Where is it going to take me? So we have to have this conversation with all our incoming college students. Make sure you're doing the things that are going to maximize your future. And that doesn't mean don't chase your dreams. But if you're going to chase your dreams, and those dreams may not add up to a nice big paycheck at the end of the day, don't do it with a whole bunch of student loan debt. So there's trade-offs, and that's the conversation we have to have. All right, I'm off my podium right now. Let's get back to the economy. How about the labor market itself? Again, good numbers there, adding about 250,000 jobs per month. And unemployment rates continue to fall. There's two unemployment rates on the right-hand side. There's the lower one, which is the headline number, running about 5.5% right now. That's one we hear on a monthly basis. And then, if you don't want to make the economy sound worse than that, you use the number above that, which is the U6 unemployment rate. And then you'll say, well, everybody says it's the unemployment rate's 5%, but really it's 10%. And if you're Donald Trump, you'll stand up and say something like, oh, actually it's 20% because I know everything, or something like that. Look, there's two ways of measuring. There's actually many ways of measuring unemployment, and there's no one right way or one wrong way. Yes, you can look at the U6. Yes, you can look at the headline number. For the most part, these two numbers are about one's 1.8 times the other one. The correlation's like 0.95. To use one or the other and pretending that somehow or other you're saying a different thing is silly. These two numbers are very, very correlated, with the exception of right now. It is true that the U6 is unusually high relative to the headline number, largely because there are many people in the labor force that are still on the outside looking in, and a lot of discouraged workers. The good news is that it is starting to fade away. Indeed, the rate of decline in the U6 is faster than the rate of decline in the headline number. People are starting to get back to work at this particular point in time. And probably most important is that U6 is getting close to 10%. By our calculations, when that thing gets to between 9 and 10%, that's when there's enough compression in the labor markets to start raising wages on the individual basis. So we're right there. We're right on the edge of all workers starting to see a nice increase in their take-home pay. And that's going to be a whole second boost for the economy through the rest of this year and into next year. Very good news. Other good news out there, participation rates have started to stabilize. And while it is true the nominal rates are kind of growing at a mediocre 2% raise, all Americans got a wonderful little boost to their income over the course of the last year or so, largely because of the collapse in commodity prices, particularly oil. Drive around. What can you get a gallon of gasoline for? I don't know, $3.5 for those folks who bought Tesla. Bad decision. Anyway. Moving on. Industrial production, we hear all the time, we're a nation that doesn't produce things anymore, largely because manufacturing employment is still very depressed. Don't confuse inputs and outputs. Yes, it is true that manufacturing employment hasn't bounced back very much, but it doesn't mean we're not manufacturing. Look, U.S. is a lean, mean manufacturing machine today, but they do so with the use of information technology and robotics. That's how we increase productivity. That's how we compete with companies in China and Taiwan and Korea and all those places that are these big manufacturing powerhouses. Indeed, we saw a very solid increase in manufacturing output between 2012 and 2014, something on the order of about 8% over the course of those 3 years. Now, it has slowed down over the last 6, 7 months or so. You see it's kind of gone sideways, and now it's kind of bouncing around in neutral mode. What happened in industrial production? Should we be worried about this? Well, what happened out there, of course, was a function of two things. One was oil, and two was the global economy. I'm going to start with the oil front. If you haven't looked, again, gasoline price is super cheap right now. The reason for that? Well, that's a huge issue. A lot of folks out there are interpreting low oil prices, of course, as a function of weak demand. And that should worry you. If oil prices start to collapse, as they did, for example, back in 2009 because of weak demand, that suggests there are bad things happening in the global economy. This is not a demand phenomenon. The reason oil prices are low today is because of global supply of oil, particularly the U.S. economy. What's interesting about this is you go back, we've been hearing about fracking for a decade now. But fracking as a technology a decade ago was brand new, and they are still trying to figure it out. And as time went on, and they got better at it, because just like any new technology, every year, kind of like, Moore's Law, where you double whatever over some certain period of time, blah, blah, blah. It's the same sort of phenomenon here, where they got better at it and better at it. And about 5 years ago, that really started to have an impact on things. Indeed, about 5 years ago, U.S. oil production just took off. That's on the right-hand side there. We went from about 5.5 million barrels of oil production today up to about 9.5 million. We almost doubled our oil production in a 5-year period. Now, is that a lot? Oh, yeah, that's a lot. Look, the U.S. has always been a big oil producer. We forget about that because we're even a bigger oil consumer, and we're very reliant on global supplies. But with this increase, going from 5.5 to 9.5 million barrels per day, we went from the 4th largest oil producer in the world to the largest oil producer in the world. Our nation is producing 15% more oil on an annual basis than Saudi Arabia is. And by the way, we haven't even touched the shale oil supplies that we have existent to us right now, more or less because falling oil prices have more or less shut down production. But there's tons of wells that have been dug and are just sitting there capped that haven't even touched. And there's all sorts of new potential places to go to. And none of that includes, of course, the biggest shale oil reserve in the nation, which is right here in California, in the Monterey Shale. It's enormous. Now, that one was a little tougher to get to, but the point is it's there. The oil world has changed completely. Now, mind you, none of this means that global warming isn't real and we shouldn't be, everybody shouldn't be plying the H3 and driving around, sucking down 2 gallons for every mile. Obviously, you have to worry about that. But again, from a short-term perspective, this is huge. And oh, by the way, are oil prices going to go back up again? No. Why? Again, because of fracking technology. On the left-hand side, there is some wonderful data. This was Goldman Sachs data, that big study they did on the marginal cost of producing oil in the U.S. economy. This was then stolen by J.P. Morgan, and then I went and stole their data. So we're all good, right? It's kind of a round-robin kind of situation. But it's fascinating because what it suggests is right now, at about $70 a barrel, the U.S. could increase its production of oil another 30% at $70 a barrel. That's it. Game over. This is a new global market for oil. It's going to be nice and cheap. Now, in the short term, there's been a little bit of an issue. In the short term, on the left-hand side there, that's industrial production in building new oil and gas wells. That's been the big hit to the U.S. economy. Big collapse there, big bunch of spending being removed. But guess what? That's done. It's over. Q2, it ended. That negative is no longer with the U.S. economy. The positives for the U.S. economy are just starting to kick in now. Yes, we have a weak global marketplace, but guess what? Airlines are still making money hand over fist. Why? Cheap energy prices. Your average American household is going to save $700 this year as a result of cheap oil prices. Logistics companies making money. And just basic local, anybody who's using gasoline, and any company using gasoline on a daily basis, cheaper prices for them. And of course, last but not least, the farmers. One of the biggest expenses at any farm is fertilizer. Fertilizer, of course, is petroleum-based. And they're going to be making more money as a result of this. So this has an enormous positive effect on our economy in the short term. Again, another big boost for the economy. Now, on the trade side, I already showed you that we did see a nice widening of the trade deficit, and that, again, was a negative hit for the U.S. economy over the course of the last couple of quarters. But it's not so much because exports have fallen off a cliff. After growing nicely, they kind of went sideways for a while. Imports, on the other hand, continue to rise, largely because of strong consumer demand in the U.S. economy. Why? What's going on out there? Well, of course, the first thing you want to point out is the fact that the U.S. dollar today is about 15% higher relative to a basket of currencies than it was a year ago today. And a lot of folks are pointing to that going, oh, that's the big issue. We've lost a lot of our competitiveness. But again, a lot of these stories that seem so obvious on the surface when you scratch away start to break down when you get into the midst of things. Indeed, in this case, if you actually look at what has happened out there in the structure of trade, it turns out the biggest increase in the trade deficit was not with Europe. In fact, the biggest increase in the trade deficit over the last year has been with China. And that's the key. While it is true that the dollar has gone up quite a bit vis-a-vis, say, the yen or the euro, actually, relative to the Chinese currency, it's been more or less flat. Yeah, there was about a 2% devaluation a few weeks ago that kind of set the markets all a worry. But that 2% devaluation was really, from an economic standpoint, almost meaningless. It doesn't really have any direct impact on trade. This all boils down to then, again, what's happening inside the Chinese economy rather than anything having to do with the U.S. dollar. Indeed, Europe, which is where the dollar went up so much, largely because of European quantitative easing, well, it turns out Europe's doing great. Industrial production's starting to pick up. The loan growth, they were all worried about the fact that banks were kind of pulling in. Well, they're starting to lend money again, and that's relatively good news. Very solid GDP growth numbers in the second quarter. Even Greece grew by 0.8% in the second quarter of this particular year. Greece is doing just fine. Yeah, there's some issues over there, and I doubt Europe's going to be growing rapidly anytime in the near future. They're dealing with a whole new set of crises having to do with the whole Syrian refugee crisis, and there's some things going on there. But the fundamentals of the European economy are improving, and they're, again, no longer going to be a drag on the economy. As for China itself, well, there things are a little more tricky. There's no doubt about it. Overall industrial production growth in China right now is running about 6%. That's the weakest it's been since the middle of the Great Recession. And fascinating, for years, a lot of folks were pointing fingers at China and saying, you're being a currency manipulator. You're keeping the yuan too low in order to promote exports. And indeed, one of the symptoms of that has been this enormous increase in foreign reserves in the Chinese central bank. That's on the right-hand side there. You can see the giant buildup starting about 2004. But look what's been happening over the last 7 months or so. Foreign reserves in China are actually going down. They are actually getting rid of foreign reserves to keep the yuan up, rather the other way around. It's a different world. Now, what's happening in China? Well, really two things. Remember that growth in China has been sort of been delivered by various parts of the economy over the course of the last couple decades of Chinese development. The first big round of growth came from export promotion, just selling stuff to the rest of the world. But you know, the rest of the world only has so much capacity to, shall we say, import stuff from China, and that started to tap out maybe 8, 9 years ago. The second big round of Chinese growth came from internal investments in infrastructure, building cities, building infrastructure, high-speed rails, turning that into a modern economy. But that again is slowing down because there's enough cities now, there's enough high-speed rails. And now China has to move to the third stage of development, which is complicated. It's going to be one that's going to be based on consumer spending in a nation that, by the way, saves a whole lot of money. It's got to be a nation that's going to be based around innovation, and it's a nation that still hasn't, shall we say, invested in property rights the way that the United States economy has. So they have some changes. Now, do I think China's going to melt down? No, absolutely not. There's all sorts of forces of growth, and after all, they're sitting on about $4 trillion worth of foreign reserves they can deploy to stimulate the economy. The biggest parts of the Chinese economy are still state-owned enterprises, and they don't go bankrupt, say, the way American companies do. The Chinese government says you keep operating, they will keep operating, as simple as that, and that will be a stabilizing force. But it is true that China is going to continue to slow down some, and I think that probably over the next few years, if you see China growing in the 4 to 6% range, I think that's perfectly reasonable for where they are now, till they find their feet and get going. As for what that means for the U.S. economy, the answer is not too much. Directly, we don't have a lot of investment in the U.S. economy. We don't have a lot of exposure to the Chinese economy, and therefore that's not that big of an issue. And as already noted, while it is true that China itself is slowing down, that money, all that savings, is now coming out of China and flowing to the rest of the world. And that is actually an opportunity, because Chinese investment in the world global economy, Chinese investment right here in the U.S. continues to grow. That money's trying to find a place to call home. And boy, if you know how to tap that through EB-5 programs or whatever the case may be, that can be an enormous potential for your local economy. So kind of a hit and miss on that particular front. I'm not very worried about it, but it's worth keeping an eye on. How about something a little closer to home? Home sales in the U.S. economy. Come out was a little bit of a joke. Guys, lighten up a bit, right? What's happened on that front? Well, again, a nice surge in sales over the course of the last 6, 7 months. It did slow down in August just a bit, but nothing I'm worried about because inventories are still very, very tight out there. Overall home prices, again, interesting phenomenon. Right-hand side is the median prices, seasonally adjusted, come from the National Association of Realtors. Left-hand side is the CoreLogic HPI. The difference between these two kind of measures is that median prices are actually not quality adjusted. It's just the middle of whatever's selling. As for the HPI, that is somewhat quality adjusted. Why is one starting to go up and the other one not? Well, again, as it turns out, while there is more activity, it's not all high-end stuff. There's actually more activity on the low end of the market. That's a good sign of an expanding housing market. It's a good sign that there's actually more activity going on for more people. Are you worried about prices? Don't be. Once you account for interest rates, it turns out affordability is still fantastic relative to, if you will, just people's incomes, or relative to apartments, as the case may be. No sign of a housing market that's gone too far. Quite the opposite. I would argue the housing market has at least 15% more appreciation before I start worrying about prices, maybe even 20%. So interest rates, once you account for interest rates, we're nowhere near any kind of bubble. Now, credit issues do remain. If you have a credit score over 720, you can get whatever you want out there. You can get money really, really cheap. But the overall pace of the housing recovery has been relatively slow, because if you have a credit score less than 720, it's very, very tough for you to go out there and get a loan to go ahead and buy a house, as the case may be. And that's been one of the big drags on construction. Look, multifamily's bouncing back. It actually is running at relatively normal levels, but the single-family market is still very, very depressed, although growing nicely. New home sales, yes, they're up 20% from where they were a year ago, and that's great news, but they're still very, very low. But again, this is a forecast. What does that mean looking ahead a couple of years? That means good things, because the housing market hasn't gotten ahead of itself. If anything, it's still behind, and it's starting to slowly but surely catch up. That goes back to that median price versus the HPI index and the difference you're seeing there. There are more people able to get credit out there. And by the way, if you're looking for a loan, there's all sorts of banks, particularly smaller banks and the credit unions, that are starting to actually loosen up. So there's more opportunity today than there was even a year ago. If you've been frustrated by one of these circumstances, it's a good time to go back and start asking again, because things really are starting to loosen up slowly but surely. On the commercial side, it's been kind of a mixed bag. The suburban stuff still not doing very guff, but the center city stuff is doing great in terms of rising rents and reduced vacancy rates. And non-residential spending, unlike residential spending, has been bouncing forward very strongly. Wide variety of stuff. Lots of new spending on hotels and offices, commercial. Pretty much everything's up. Even manufacturing. You know, we talked about how there's been a bit of a slowdown in the manufacturing base, but there's been a 70% increase in investment in manufacturing facilities in the U.S. economy over the course of the last year. Very solid numbers there, again suggesting a growing economy. Now, as the only part of the construction markets that continue to worry me is public construction. We've heard about this. We've heard the stories about rotten roads and collapsing sidewalks and all the problems that are going on there. Well, I can't probably show you this picture any better than this. On the left-hand side, the right-hand side there, excuse me, is public net investment as a percent of government revenues. That is to say, it's the new investment in infrastructure minus depreciation of existing assets. Never has that been lower than it is right now. Very, 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 very poor numbers. We're just not putting the money we need to into our economy again. Why? Any number of reasons. It isn't all just, shall we say, employees grabbing up lots of money. In fact, there's been a big increase in the cost of social benefits for local governments, unemployment, some of the healthcare stuff. At the same time, subsidies from the federal government have not been growing very rapidly, largely because of the austerity measures being put in place in D.C. Of course, a lot of local governments have not been willing to raise taxes, and a lot of the expenses that they avoided back in 2009, 2010, they deferred. Yesterday's deferred expenses, today's expense, and you can go through all the different reasons. But it is a problem for the U.S. economy. Things have started to change. In fact, for me, one of the more encouraging signs is on the right-hand side there. That's state and local employment. And you can finally see on the right-hand side, they're just starting to pick up just a little bit. That's hiring teachers, by the way. There are actually more teachers being hired. We're finally reinvesting in our education, which has been well needed for a long time. That's relatively good news. But from my perspective, we're still very far behind on this particular front. And of course, last but not least, let's not forget the pension problem. The pension problems, of course, is quite serious, not only here in the U.S., but really in many parts of the developed world, and of course here in California, as the case may be. This is some data on a state-by-state basis as to the share of actual funding and the underfunded liabilities relative to personal income. Alaska, by the way, has the worst pension problem out there today, with a shortfall about 25% of state personal income. You got Illinois about 16%, Mississippi about 15%, wide variety of states that are far behind, as the case may be. California, we're in there. We're in the top 15 or so in terms of pension shortfalls, a problem we need to face. And of course, remember that every time they lower their expected returns on those pension portfolios, the payments increase, and that's been a big issue as well. So something, again, we have to face from kind of a medium-term problem. Now, what about returns? That's one of the big questions. As you know, CalPERS continues to assume about a 7.5% return on their portfolio. That seems a little unrealistic in our market today. And of course, that might even be scarier if you think we're on the edge of a bubble. Are we there? Should we panic? Should I be putting all my money under the mattress again? No, you should not be. Yes, I know the market's dropped about 10% and have been kind of wobbling from where they were last year at this point in time. But forget the markets. You know, we hear all the time, you pick up the Wall Street Journal and they'll tell you that the stock market knows all, sees all, and everything they do is reasonable and rational. The actual situation is this. The stock market, particularly today, although it's always come kind of like this, the stock market acts largely like a pack of espresso-fueled first graders playing full-contact musical chairs, okay? And it flops around all over the place for really very little reason whatsoever, except for somebody thinks that somebody else thinks that somebody else thinks something, okay? And to me, it's craziness. I'll give you a classic example of this. Everybody on Wall Street is just... every minute of the day, everybody's watching. What's the Fed going to do? What's the Fed going to do? What's the Fed going to do? The answer is, who cares? It doesn't really matter that much, yet they're so keyed on it, it's becoming an enormous issue in the financial markets for no reason. Now, why am I so confident it's not a bubble? Well, 4 reasons. 2 about the financial markets themselves, and 2 about the economy overall. But the financial markets themselves, look, yes, asset prices are going up, but they're going up because of fundamentals. They're going up because companies are making more money. They're going up because there's more demand for housing. They're not going up because people are speculating. Second thing is, a lot of the numbers make sense once you account for low interest rates. And you might say, well, there you go. Once the Fed starts charting, that comes to an end. No, No, interest rates are not low because of Fed policy. That is completely incorrect. Interest rates are low today because there's a heck of a lot more supply of capital floating around the global economy, and there's demand for it. Simple as that. It's a supply-demand phenomenon. And that's not going to change anytime in the near future, not while China maintains a 45% savings rate. Simple as that. Now, what about the real economy? Well, again, the real economy is something you need to look at as well. Why? Because the financial markets by themselves are irrelevant. You know, if you talk to anybody in the kind of the financial biz, they will tell you the worst day ever was Black Monday, October 1987. Black Monday. The markets dropped 35% in 2 days. 35%. And what happened to the rest of the U.S. economy? The other 99.5% of economic activity we call the rest of the U.S. economy? Nothing. Nothing happened whatsoever. U.S. economy continued to grow. 88 was great. 89 was great. Nobody noticed. And it wasn't until 1990, after the savings and loan crisis hit and all those problems started the U.S. economy, only then did we finally get into a recession in the early 1990s. It didn't matter. And that's the key. Financial market prices up and down don't matter much for the real economy unless the real economy is also out of whack. When you go back to 2008 and 2009, it wasn't the stock market went down. It wasn't that home prices fell. It's that people have been spending up to that point in time way more than they should have on the basis of money they were borrowing against their overvalued real estate. It was because the housing market itself was vastly overbuilding single-family homes. It's because the U.S. economy overall was running this huge trade deficit, unsustainable trade deficit. And, of course, it was also because the Wall Street firms had themselves leveraged up like nobody's business. Because that's the fourth point. If you're scared about the financial markets, if you're scared about the economy, the key here is to pay attention to leverage, the use of debt. When the economy's leveraging up, that's when things are looking dangerous. Because leverage magnifies everything. And by the way, leverage is also a sign that people are, shall we say, swinging for the fences. They're trying to get the big hit. They're taking excessive risks. Well, where are we on the leverage front? And the answer is nowhere. We've literally just come out of the last deleveraging cycle. And leverage is not an issue in our economy today. So there's nothing here that worries me, and there's nothing here that should worry you. So let's go through this real quick. Again, corporate profits, record high level right now. And once you account for those low interest rates, it turns out the equity earnings spread is looking fine. In fact, it looks a little wide. As for technology itself, we've all heard about tech, or are we worried about the unicorns, those billion-dollar businesses? Look, this is not 1999. 1999, you were in San Jose, you had a nice suit and a website, they gave you $100 million, okay? Today, not the case at all. Today, businesses have to have plans. Today, the PE ratio in Silicon Valley is 27. Back in 1999, it was 152. And, of course, remember that back in 1999, it wasn't just or 2000, it wasn't just that tech stock prices started to fall. It was that the companies have been pouring billions of dollars into information technology and not making any money. Today, you don't make money without information technology. That demand's going to remain in place because that is how you succeed in today's global marketplace. As for the leverage itself, again, this is debt outstanding as a percent of GDP in the U.S. economy. Financial leverage still falling. Non-financial business growing at a nice steady pace. Consumers just deleveraging out now. Public debt leveraging out as well. No problem there. Banks lending at a nice steady pace, mainly C&I and commercial loans. No problem there. And, of course, as noted, interest rates nice and low. Mortgage rates, again, are well under 4%. Almost no sign of inflation whatsoever. Now, remind you, over the last couple of years, there are people screaming about hyperinflation. Hyperinflation is going to come crashing down at any moment now, largely because of quantitative easing 1, 2, and 3. Well, quantitative easing, while an important program for U.S. recovery, was never about lowering interest rates and in a very real way, it was never about, if you will, creating inflation as well. Yes, they put $3 trillion in QE out there, of which 85% sits in the banks in the form of excess reserves. $2.5 trillion of excess reserves sitting in the banks. As long as that money sits there, and there's all sorts of reasons it should and can, there's not going to be any sign of inflation. The monetary base is growing at a nice steady base once you account for those excess reserves. And ask yourself, okay, well, if it's not the Fed, why are interest rates low? And the answer, of course, goes down to the fact, again, we have a global savings glut. Lots and lots of people out there saving. All these pension funds trying to catch up. And China putting money all over the place. When you have that kind of excessive glut of savings relative to demand for capital, that's a low interest rate environment. That's not going to change. And what about the Fed? What about it? The Fed fund rate, everybody's keyed on that. What is Janet Yellen thinking? What's she going to do next? They're probably going to raise. They've signaled that pretty strongly. They're going to raise this fall. But here's the key. For the vast majority of people out there, they don't care about the federal funds rate because that is an interbank lending, an overnight interbank lending rate. That's all it is. The pass-through of the federal funds rate to the 10-year bond is about 1 to 10. That is to say, if you raise the federal funds rate a full 100 bips, you get about 10 bip increase in the 10-year bond rate. That's it. So will they start to tighten? Sure they will, mainly because of the psychology of it. But remember, right now the 10-year bond rate's floating a little above 2%. They don't have a lot of space to maneuver in. If they raised it 200 bips, you'd flatten the yield curve and create havoc in the financial markets. They know that. I know that. So are they going to raise? Yes, but they're going to raise very slowly in tiny increments because they don't have space. Now, does that mean the Fed can't deal with the next downturn? Of course they can. They're going to use quantitative easing again. That is going to be the new tool of Fed policy in our low interest rate world, as simple as that. Now, how about California? I'm falling a little behind here. That's what happens when you get excess space. California, what's happening here? We've heard all sorts of bad things about our economy. I was on a panel at Bond Buyer Conference, and the economist from Standard & Poor's, she had this question for us. Looking back a few years, 9 and 10, everyone was saying that California would fail like Greece and Detroit. Things look different now. What has happened to turn things around? Well, the first thing I said is not everyone said that. It's a silly thing to say. After all, the California economy, as business-unfriendly as we are, and I know we are, I'm a small business person here too, that's not the defining feature of what makes an economy grow. People want to be here. We have some of the greatest industries. We have an incredible state we live in. People want to be here. We're wonderful universities. I can go on and on. People want to be here, but that's what it boils down to. And as long as people want to be here, we're going to do good. And you can see that, over the last 3 years, we've grown about 2.5% per year compared to the U.S. 2% overall. And that's being driven by information, by manufacturing, by professional services, by education and healthcare. That's the stuff that's growing in our state faster than the rest of the nation. Over the last 3 years, California has been the third fastest growing economy in the U.S. from a job growth perspective. We're only Utah and Nevada are growing faster than we are at this particular point in time. And again, broad variety, professional, healthcare, leisure, hospitality, high-paid jobs, low-paid jobs across the board. And of course, it's a broad mix. Everybody's growing. It's not just the Bay Area, as the case may be. Jordan, of course, is going to be getting into the Inland Empire here in just a couple minutes, growing about 3.1%. Tourism is doing great. The airports are busy. Exports are keeping up and down a little bit from last year, but still doing great. And if you look at what we're exporting more and more of, on the right-hand side, I have a share of export growth from 2009 to 2015. 20% of that increase in export by value, computer electronic products. We're selling all sorts of stuff across the globe. Number 2, ag products. Huge growth there in terms of exports. Machinery, transportation equipment, miscellaneous manufacturing, electrical equipment. All sorts of stuff growing right now. Now, the one that may surprise you the most there is that big increase in exports of agricultural products, because as you heard, we have a drought. Well, not quite. What's the difference between a drought and a water shortage? A drought is a water shortage that has significant economic consequences. And that's the key here. We don't have a drought, we have a water shortage because we haven't seen any significant economic consequences, at least not yet. You say, well, look, third fastest growing labor market in the U.S. for 3 years. That doesn't sound like an economic consequence. What about ag? Isn't ag getting crushed? Well, as it turns out, ag employment is at a 20-year high. And on the right-hand side there, ag earnings down from last year, but 40% higher than they were any time before 2009 because of the huge increase in prices. Ag's not suffering, folks. It's as simple as that. There's no information that would suggest that. Look at the numbers. Our ag economy has been so crushed that last year we were only able to grow 930,000 acres of forage. By the way, for those of you wondering what forage is, that's alfalfa, otherwise known as hay. Yes, last year we had enough water to grow 1 million acres of hay in the state of California. And by the way, what did we do for that? Isn't that a critical component in the California dairy industry? Yeah, sure it is. But actually, the biggest increase in the use of hay in California is to be put on boats and shipped to China. Yes, we have enough water in California to ship hay to China to feed pigs. Think about that for a second. As for crop losses themselves, relative to the drought, about $250 million out of a $40 billion crop. People are looking at me like, are you serious? Yeah, I'm serious. This is actually what's going on out there. You're not supposed to take a shower so we can feed Chinese pigs. Doesn't make a lot of sense, folks. Housing continued to grow forward at this point in time. Prices up. That was sort of a historical unaffordability is creeping back in. There is no bubble. Affordability is still good in the state. There's very tight supplies out there today. High housing prices are here because we don't build enough. We don't build enough because of CEQA and Prop 13. For me, one of the biggest frustrations is while everybody in Sacramento understands we need to do something about the affordability problem, they're not talking about these two issues, CEQA and Prop 13. CEQA, of course, California Environmental Quality Act, which allows every NIMBY and special interest to try and hijack any kind of project for their own benefit. And, of course, Prop 13, which limits the value of property taxes to local governments, which inherently turns them against residential development. Look, if you're a city manager and you're trying to balance the budget, you're looking at different things you can build. Give me retail. I love it. High density residential, that's the worst, because it costs you a ton and you get nothing from a property tax perspective. So these are the problems when no one's talking about it, as simple as that. And how do I know these are the problems? And why am I worried about this? You know, I love these net migration numbers. This is net migration from 2008 to 2013. Who leaves California? Lower income folks. We hear all the time, high income folks and entrepreneurs flee the state because of taxes. Really? Actually, we import people earning over $50,000 a year. We export folks whom are earning less than $50,000 a year. This is housing. It's not taxes. It's housing, as simple as that. And it's such an important issue. And by the way, that's even true for Texas. You don't believe me on this? Over the last 5 years, more people earning over $100K a year have moved from Texas to California than the other way around. Think about that. This is where you cue the Beverly Hillbillies theme song. As for permits, still relatively weak, multifamily bouncing forward, but non-residential, again, because they love that stuff, that's bouncing forward nicely. Again, all sorts of evidence California economy is moving forward very nicely. So to wrap up, before I bring Jordan up on stage here, what to worry about and what not to worry about. This is a great place to end. So what you should worry about and what shouldn't you worry about? So what you shouldn't worry about is the US dollar. What you should worry about is China. What you shouldn't worry about is student debt. What you should worry about is educational choices. You shouldn't worry about asset bubbles. You should worry about bad financial regulations. You shouldn't worry about drought. You should worry about water policy. Don't worry about consumer spending. Do worry about savings rates in the long term. Don't worry about labor markets. Do worry about growing inequality. Don't worry about California business. Do worry about California housing. And, of course, don't worry about taxes. Do worry about a lack of public investment. Don't worry about politics, but do worry about a lack of public engagement. Because more often than not, I think so many of us are getting discouraged out there because of the rancor and hysteria that seems to go on in our political debates. But you know, in the end, the reason you're here this morning is to actually get re-engaged in the political process. You know, we have 2 county administrators, folks running San Bernardino and Riverside County with us on stage in just a little bit. And these guys are here, they do their job on a daily basis because they are trying to get things going. They want to make things right in this area. But you need to be involved in that process because they can't do it alone. Business, academia can't do it alone. We all have to work together. And in a sense, that engagement is just so important. And that's one of the reasons, again, why we're here today, is to start that process of engagement. So with that, we got a couple little bookkeeping things. First of all, you do have the opportunity to question me, and that's going to come after Jordan has a talk. Second thing is I think our high school students are now going to have to go on to, shall we say, other things. So I think they're going to be departing. Thanks for joining us this morning. And then, last but not least, I want to invite Jordan Levine up on stage to take this conversation from the big picture and bring it home. Jordan Levine, everybody, my chief researcher at the brand new Center for Economic Forecasting and Economic Development. Thank you very much, everyone.